Cognitive biases significantly impact financial decisions, often leading to misjudgments. Common biases like confirmation bias, overconfidence, loss aversion, and anchoring shape how we interpret financial information and act upon it. For example, confirmation bias leads investors to focus on data that aligns with their beliefs, ignoring contradictory evidence. Overconfidence bias results in frequent high-risk trading, often with negative outcomes. Loss aversion keeps investors holding on to losing stocks too long, hoping for a rebound, while anchoring bias skews value perception based on initial prices. Awareness is the first step in counteracting these biases. By recognizing patterns, diversifying investments, consulting outside perspectives, and applying structured decision-making methods, individuals can make more rational financial choices. Techniques such as dollar-cost averaging and engaging with advisors help counter the emotional influence on decisions, paving the way toward better investment outcomes and financial stability.
Martha, why do so many of us make irrational decisions when it comes to money? And why are cognitive biases so difficult to overcome?
Because I think financial decisions, you mentioned earlier, fundamentally, decisions we make about money are really emotional decisions. And we just use reason and logic as the window dressing to rationalize the emotional decision we've already made. And they're very immediate, very rapid.
Saundra, your thoughts, like these cognitive biases, do they also contribute to the racial wealth gap that we see?
Yeah, absolutely. And to build on what Dr. M is saying is that so often we don't even know that we have them. I think that's the biggest factor and the deepest awareness for me. So often we don't even know that we have the bias. And so we're not looking out for it. I noticed in your intro, you said that, sometimes very intelligent people still struggle with the psychology of money because I would say the more intelligent you are, the more you can actually fall victim to some of the biases because we think we know, we think we've got it. And usually that's based on our past beliefs that, we might not even know are there. So when we think about it in the context of the racial wealth gap, Black people in the diaspora, literally all over the world experience a different relationship with resources because of the history of the African diaspora. And so when we have an embedded struggle with self-worth based on what other people have put upon us, it can certainly cause us to feel, it shows up in ways like we have to do twice as much to get half as much. We have to be twice as good to have half the opportunities. So those types of things become part of our DNA, if you will. And then we behave in ways that maybe are harmful by believing something and having a bias that isn't necessarily not only the actual truth, but isn't even really our truth.
So where do we start? We have to identify what potential biases are so that we can identify where we are right now?
So I think Martha was going to jump in with something, but I was going to leave it to Martha and Mariko to say a little bit more about that.
I'd love to hear what Mariko has to say about that.
So I have actually.
I know. Go ahead.
No, you gave me the opportunity and I just leapt at it. So I will say my piece quickly and get out of the way. I have a very practical suggestion. And because is Morgan Housel's book, The Psychology of Money. I think that's a great way to understand things and to also create the kind of gap in self-awareness that allows you to maybe catch yourself before you fall into something. But I think it's a really accessible book, and it's a great combination of both explaining the psychology and our brains are wired for. The evolution of our brains has trailed the evolution of our society and technology, with also just practical investment takes on it.
So your assignment is to go read the book.
Yes.
Martha, your thought?
And I just wanted to point out that one of the things that also can um, make people kind of fall back on cognitive biases when they're making financial decisions is when they're under stress. If you are a person who is under-resourced, the not only the cognitive biases that you might hold, but just the way that stress affects our brains um, can make us um, make poor financial decisions. There was a really well-known psychology study involving children, the Marshmallow test. Are you familiar with that? Basically,
I am, but
they
please explain.
so basically the researchers gave children one marshmallow, told them that they were going to leave the room for a few minutes. If they could resist eating the marshmallow, that they would get a second one if they waited. And it was a study about delayed gratification. And then they followed up with those kids later in life. And the kids who could delay gratification and sit on their hands instead of eating the marshmallow right away did better kind of across the board. There were some issues from a research perspective with that, but one of the things about that study, as people have looked at it a little more critically, there was a tendency to blame people for not being able to delay gratification. But if you've grown up with financial instability, it can make a lot of sense to go ahead and, eat the marshmallow that's in front of you instead of, hoping that there's going to be a second one there when your experience has been that, well, maybe it will, maybe it won't. So, we just, I think as financial professionals, we want to be careful about labeling people. And sometimes what seem like poor financial decisions are actually quite rational given somebody's circumstances or history.
So it is very individualistic based on your own experiences. I want to ask everybody the same question. What's one cognitive bias that you've personally encountered in your financial journey? And how were you able to overcome it? Saundra?
Yeah, so mine is, there's a list of them, right? I'm going to go with the recency bias, right? And so the thing that just happened most recently is the thing that I anchor to, right? And there's also the anchoring bias, but the recency bias is that things that have just happened are likely to continue to happen. And I know Dr. Martha has a much better way of saying that. That's how I understand it. And so how that affects me is that I was raised with a mother who was entrenched in deep poverty. She was one of 12. And so every time she made money, she rapidly spent it. And that's how I was raised. And her philosophy was there will always be more money, right? So she could always get a second job. She could get a third job or a fourth job to do whatever she had to do. I did the exact same thing. So I had to make a different choice to, as Dr. M pointed out earlier, that about that emergency fund, I had to, so there's that thoughts, beliefs, behavior triangle, right? That those three things kind of perpetuate our beliefs, our behaviors, and how we think about money. Sometimes we're able to change how we think about it. Sometimes we're able to change what we believe about it. And sometimes we have to focus on the behavior. In this situation, I had to focus on behavior. So I had to force myself to save, even with a master's in financial planning. I had to force myself to save because it wasn't part of my belief system and it wasn't part of my bias and how I operated.
How about you, Mariko?
Wow, so many biases. I'm probably guilty of all of them. I would say as an investor, and a more value-oriented investor, right? You have to, one of the things I had to learn is it's very easy to let your winners, to be trimming your winners and reallocating to your losers, but you also have to make sure that your losers are not going to be lost forever, right? And so it's not that thing where you wait for it to get back and break even and then sell it, because usually by then, if it's actually sort of, if you have a dead cat bounce, fundamentally that moment, the company's doing better, it will continue to do better. So it's not about just getting out, but it's just interesting to be able to have to overcome those knee-jerk instincts and really look at what's going on fundamentally with the company. And I had very long holding periods. I've held stock. Our average holding period was 3 years. That seems really long now. I've held stock as long as 10 years. So those were the things that the itch is to take risks, to trim winners and put money towards losers. And one of the ways I overcame that is actually to have a whole study done and data to look at and see that, and then we could actually measure when we were falling prey to those biases.
Follow the data. How about you, Dr. M?
Definitely anchoring bias. This is like a well-known marketing trick. I have to always remind myself when I see something that's, it's on sale this week for $149. That 9 gets me every time. I have to remind myself, we're really talking about $150 here. So just kind of reminding myself to round up.
It's a good one. Yeah, I have a hard time passing up a sale, even when I don't need it. But that's me. All right, let's go to segment 2.